Hey guys, so today what we're going to do is look at multi-time frame analysis and start to really unpack multi-time frame analysis to give you guys a very clear view as to how to use it, how to combine time frames to place high probability trades. We're going to just start with a tiny bit of theory and just some logic that will help us as we get into the charts. Starting with what multi-time frame actually is. So very simple statement here. Multi-time frame analysis, I often refer to it as MTF, is essentially executing higher time frame trade ideas. So what is happening on your higher time frame, in my case, monthly, 2-weekly, weekly, with lower time frame trade execution. So combining two time frames in order to play a higher time frame trade idea by executing and taking entries on your lower time frame. So very simple, very, very simple. Why multi-time frame analysis? Price is fractal. So what happens on a chart, on any financial asset, price is price. What happens on the 1 minute is happening on the 5 minute, the 30 minute, 6 hour, daily, etc., etc., etc. However, what you're looking at when you look at a candlestick chart is how price printed for a specific time period. So we can see by analyzing candles a very strong picture of what happened between supply and demand in the market within a certain time frame that we can then use to create stories, to create an understanding of what we think is going to happen in the future. And what multi-time frame analysis allows you to do is to see over sustained periods what's happening in the market in order to time what you think is going to happen in the future. And what you get on the lower time frame, as I say here, is a lot more detail. And what we tend to see is that structure on those lower time frames, when you have very strong higher time frame targets, gets respected. So you can place much higher probability trades on lower time frames by just understanding the combination or the relationship between time frames. This is something I just wanted to put up that you can come back to. This is not a hard and fast rule. So you'll see different versions of this across different YouTube channels where people say you have to stick to certain time frames. I can tell you it is not true for the reason that price is fractal. It's really about understanding what you're looking at on certain time frames to understand whether a trade is or isn't something that you should take. But there are definitely relationships between time frames that are stronger than others. So if you're a scalper, this and going down even further than this, you might be looking at your higher time frame as anything from an hour candle down, and you'd be taking entries on sort of the 1 to 5 minute. You might even be looking at the 4 hour for that with your lower time frame at the 5 minute. But typically, if you're either a scalper or a day trader or intraday trader, you're looking at that 1 day or 4 hour candle as your higher time frame, and then you're executing on something like the 15 minute or the 1 hour, potentially up to the 4 hour. However, as you get up to the 4 hour, then you're looking more at longer term positions whereby you're timing your higher time frame as, say, maybe the weekly candle or 2-weekly candle. What I've found is my sweet spot is anything from the weekly candle to the monthly candle, and executing with the 4 hour up to the 12 hour. What works very well, if you're willing to put the time in, is to use the 12 hour as your sort of gauge to time the weekly, 2-weekly, monthly trades, but even taking it one step further and going on to, say, maybe the 4 hour to time your entry within your 12 hour idea. This is getting a bit ahead of ourselves, and we can get on to how that works maybe in this video or later videos. But what we're going to look at today is looking at 2-weekly positions using the 12 hour time frame. But just remember, this is completely fractal, so you can adjust this to meet your strategy. Then if you want to get up to, say, monthly candles, you're looking at daily 12 hour through to, say, maybe the daily or 2 daily candle as your execution time frame. Why do I swing trade? This is, I guess, just a little plug. And if you don't want to swing trade, just skip this section. But why do I swing trade? It gives you back time, freedom, and control, which I talk about a lot as being reasons to get into trading. We want more time. We want more freedom to do the things that we want to do. Maybe that is to work around a career, to embed trading around a career, around a family, and ultimately to give us more control over everything from time, freedom, but also financial control and so on. I found swing trading to be a very nice way to balance trading amongst my everyday life. When I was working and had a career, I could still trade. I have a family, I have 2 kids, I can still trade. And I don't need to be pinned to the charts. I can look at the charts fairly infrequently and still take very good trades. So second point, it works alongside a very busy lifestyle for the reasons I just mentioned. What I tend to see as well is you get less noise. You do get a lot more choppy price action on the lower time frames because ultimately market makers are trying to manipulate people in and out of positions all of the time. So I've tend to see that while this does happen on higher time frames, you just get a little more respect of structure, and so a bit more clarity as to what price is wanting to do. And then another great reason is that news is a good thing when you're swing trading because it's the fuel, it's what puts volatility into the market. When you're in sort of intraday positions or scalping positions, you can get a news announcement, and even if you're right on the market, you can get stopped out of your position, or maybe your prop firm doesn't even allow you to trade through news. When you're swing trading, it's almost baked in. I don't want to say you don't need to look at the news calendar, but what you see in your technical analysis often plays out through news, because news is that injection that price needs to actually push towards a high that you might be targeting, for example. Finally, day trading is just as good as swing trading. Swing trading is just as good as day trading. There's not one that is better than the other. So if you have the perception that you need to make tons of trades all the time, you need to be active in the markets, it's really not the case. What you need is patience and discipline. If you can get patience and discipline into your trading, you can sit in swing positions and go and just live your life. Once you get an entry, you might be sat in a trade for a week, but that doesn't mean it's not a good trade. And you might win that trade, I don't know, make a couple of $1,000, and actually you're taking 5-10 trades on the daily time frame that you win, lose, and you actually end up with your $10,000 anyway. We'd love to make $10,000, but what I'm trying to say is that swing trading is just as good, in my opinion, better for the reasons that I mentioned than day trading, but it's definitely personal preference. So now, how do we apply this? And then we're going to jump on the charts now. But it's about creating stories with higher time frame candles, understanding the relationship between higher time frame candles, and then timing those candle ranges with lower time frame execution. That is the definition of multi-time frame analysis. And if you can do this, you can create those stories, then you can be very successful with forex trading or trading stocks, futures, whatever it is that you want to trade. So I'm just going to show you 2 examples. And I'm just going to actually put this up here. We're going to do a continuation trade and a reversal trade. In fact, we'll do the reversal first. So both are going to use a higher time frame candle and story, and both are going to use lower time frame execution. One, I think the reversal is something I called on X this week, and I am going to show you how it's playing out. Why am I writing this? I don't know, but just to make this explicitly clear. So we're going to do a reversal trade, continuation trade, and then we're going to use higher time frame candles to create a story. We're going to then use lower time frame execution for our trade. And we're going to do this on live markets, and you can actually go back and check my X account if you want to see me call this ahead of the move actually happening. So as I said, we're going to look at the 2-week candle, and and I'm not going to spend ages on this today, but one of the ways that I like to trade is using candle range theory. Sorry, don't know why I hesitated there. Just drawing this out, which is where we like to see price. This is going to look a bit budget, but just to show you what I'm looking at. What I like to see is essentially, this is candle 1 right here. So here we go, candle 1, candle 2, candle 3. Sorry for it being a mess, but this is just to really bring to life what I like to do when I'm trading, by using these higher time frames to create the stories that we're going to trade on the lower time frame. So what happens here is we have a manipulation candle, and I'm going to do other much more thorough videos on this, but you've got manipulation candle here. Then what you see with, sorry, this is your accumulation candle. This is where price is being driven down. Then we have a manipulation candle, and what the manipulation candle does is it liquidates the previous candle and closes inside its range. So price in this bottom wick traded through candle 1 and closed inside of candle 1's range. So when this happens, what price typically does is it either targets 50% of candle 1's range and then continues, or it targets 50%, maybe finds some support, and then targets the high of candle 1. So what I'm looking at is we're going to map all of our order blocks, our fair value gaps, our breaker blocks on these higher time frames, because they can act as support and resistance for our next move. But crucially, what I want to see is this type of thing happening. Old highs and lows being reactions for price that we can then use to trade these types of moves on lower time frames. So with that said, what we have here is this playing out. So if we look at EuroCAD this week, or after the close of the last 2-week candle, just going to add this here so we can see this as actually we don't even need to write it on, but this would be our low and this would be our high. So let's put high, low, just going to mark that. Okay, so we have high and low. So we're not going to spend ages really going into why this would be a good CRT, but I just want to show you the way that we can shape these higher time frame ideas to then move on to the lower time frame to take these executions. If we look at the structure of the market just before we do this, because I think it is also important to cover, we have price coming into a 2-week order block, continuing higher and then coming back, and we do have a shift here. So if we look at the 2-week order block, you can see right there is buy pressure in the market that then sells through. We're now coming into an order block, and we might now want to continue lower. But crucially, what price does is it takes liquidity before it makes these big moves, especially on these higher time frames. So as soon as we get this close here, it might be that we just want to trade into the midpoint of this candle and then continue lower. But there is strong reason to believe that we're going to complete this CRT first. And we can look at even higher time frames here to validate that idea. But if we just work on that basis, once we drop down to the 12-hour, we can now combine what's happening on our lower time frame to actually make trade decisions on our higher time frame. And what I have here is both the monthly candle and the 2-week candle behind 12-hour price. So you can see the monthly candle, if we look at this entire period here as our monthly candle. You can see there's another one. Right, this is the high of the candle down to the low of the candle, and this is the entire price action traded for that specific month. Then within here, what we also have, we'll just take the monthly away for a second, is the 2-week candles. And what we've seen here that we've actually looked at is that price on the 12-hour came down, traded through this 2-week low, and then what we're looking for is a shift in structure that we can potentially trade. And I'm just going to mark this out for you so it's very clear. So if we look at 12-hour structure here, we've got 12-hour order blocks being respected in the market. Let me just bring these forward. And then what price does is tries to create another order block here. This buy to sell, liquidates the low of this candle, but it doesn't ever close below that order block. What ends up happening is price does this instead. We go up. What we expect to see is that this gets respected and we continue lower. What actually happens is we come in here, we can't go lower, price doesn't want to go lower, and it does this. So now we have a structure shift in the market from high to low, high to a failed low, a failed close below that level, and a shift. So now we can use areas or points in this price leg to look at getting involved in this market to take longs to complete this higher time frame idea. And this I'm just going to mark out quite explicitly for anyone watching is the new 12-hour order block. So here's the order block, and then within this, what do we have? A fair value gap, an imbalance in price to the upside that we can use as fuel to go higher. So you can simply create an order. As soon as this candle closes, this 12-hour candle closes, you know you have an order block. As soon as this candle closes, you have a fair value gap. And then you can just cover the order block. Price, you can see, has already liquidated that low. So there's no reason for price to return to this level. So really, you could even be more aggressive with your stop, but I like to just cover at least the order block. And then you can target the high. There we go. So 2.13. And whether this gets there or it doesn't, it's not the point, because if you're a good trader, you have good risk management, and you play these types of trades for long enough in the market with this type of edge, you will be profitable. You can take a 2R. We're already out of a 2R. If you want to hold to the target, you've got a 2.13R. So that's the logic. We had a strong higher time frame idea. We waited for structure to shift on our lower time frame. We had a very clear point of internal liquidity that we could use to target. We had good risk management, and we were able to take a good trade. And this is called live on my X this week. So that's idea one, and this is a reversal trade. Price is in a bearish trend, and we reverse to target the high of this candle. Now, what we're going to look at here is the exact same thing. So right here on GBP AUD, we had a very strong bearish monthly candle. So this entire price action that you can see here was the monthly price action between October and November for GBP AUD. Price closed below this candle's low. So anywhere in this candle, we're expecting price to continue lower. However, mid-candle, what happens is we get a liquidation of this low. And this just happens to be both the monthly candle's low, but also this 2-week candle's low, which you can see in here. And what do we get? The exact same thing. So you've got 12-hour order block right here. So price is in a downtrend. From here, we get a retracement into this order block, low, and then we come right up and test this level, and then we come in, we go up, we don't take the high, and we retrace. So again, what have we had? We've had a structure shift here. We've had an order flow shift in this first price leg. So both are tradable to target this high. So if I just take this away and we just map this on, and just bring this visually to the front again, and we're just going to map how price is actually reacting here. So we come down, we have a fair value gap in this price leg right here. And what happens? Price just trades straight through it. So if we wanted to continue bearish, price would just do this. We've got a previous bearish monthly candle. We come down, we would fill this internal range liquidity right here, and then we would continue lower. But we don't. We continue higher, and we create a new order block. Now, in this initial price leg, there is no fair value gap. So it might be that you want to be conservative here, but what we get in the second price leg is a fair value gap. So order flow is bullish. Even though we get this bearish price action, we still have bullish order flow, and we have a clear target. So the two areas that you can get involved in here to target the high are the first order block. You either want to cover the order block itself or the liquidation of the previous candle. Let's just do that. And then we have a target right there. So 3.19 our trade, or 2.56 if you want to be extra conservative. That's your first entry. And then your second entry could be off this fair value gap right here to target the high for a 1R trade. So a 1-to-1, fairly low risk. Or if you want to wait for the order block, cover the low in the same way, you would be looking at 1.4R trade. So I'm not a massive fan of fixed rule profit targets. I prefer to work from points of internal liquidity to highs that I'm targeting, because as soon as this high is taken, the trade idea on the higher time frame is over, unless what we see is this entire monthly candle closes, which it actually did, which now creates a monthly CRT, which may expose this high to be targeted. But you know, the price action since would have stopped you out of these trades. So this is where time frame analysis has to come in, because if you're looking at targeting that high, you need this candle to close first, and you're probably looking at maybe the daily, 2 daily as your execution time frame. Similarly, if the higher time frame was, if you were looking at maybe like the daily candle here, it wouldn't make sense to be placing trades on the weekly or 2 weekly candle, because price is going to be liquidating daily and hourly levels in here in ways that will stop you out of the trade before you meet these higher time frame targets. So that's a whistle-stop tour of multi-time frame analysis. There's a lot more that goes into it, because in the same way that we're looking at structural shifts here, we can do this on the higher time frames, and we can use that analysis to make even stronger, firmer, higher probability or confident trades on lower time frames. Because when you're looking at this stuff and it plays out, it looks great, but there are reasons why these might not play out, and it can lead to frustration. So trading is something that you need to be constantly learning, evolving with, and bringing in tons of different aspects to your trading. But this is one of the core foundational areas: higher time frame candles and stories, lower time frame execution. And if you can marry those two things, then just with this alone, you can reach profitability. I do believe that. But subscribe to the channel. I'm going to be teaching a lot of different concepts, and there's a lot more to go into. So see you on the next one.